investment is not a get rich quick thing.
Yeah.
Don't be in a hurry. Assets actually are things that make you to be rich. Liabilities are things that make you to be poor. What drives the market is liquidity. Once you have liquidity, then the market is going to move very well. If you don't have liquidity, it's a very fragile environment to work in. Some people cannot stomach volatility. Yeah. If you cannot stomach volatility, don't go to crypto. I mean, on the 10th of this month,
people lost their lives.
People lost their lives because crypto lost 19 billion. Traders, 1.4 million traders were liquidated to the tune of $19 billion in just 24 hours.
Now, one of the major questions people actually ask is, what is the best time to actually invest? Some will say, is it when there's a policy change? Others will say, when inflation comes down, by your own advice. Now, what is the best time to actually invest in the market?
One terrible thing you can do, which is trying to time the market. Like they would say, time in the market will always beat timing the market.
Now, when me and my team actually concluded to dedicate one particular episode of Clockwise to the stock markets, we had a little problem in sorting out the names of those we are going to bring as guests. Now, there were so many names, but one name keep reoccurring. Now, he has reoccurred so much that I don't need to even introduce him in the show again. He's somebody that we already know. Now, he has been here a couple of times, several times to discuss. The last time he came, we discussed about the Nigerian movie industry then. And today we are having him again. And today we are discussing the stock market, both local and international. My name is Providence. Welcome to Clockwise. And my guest is somebody you want to listen to as usual. Please help me welcome Mr. Kandem. Welcome to Clockwise.
Thank you very much.
I admire you a lot because I think that, is there any topic you cannot talk about? Can you talk about soups? Can you cook?
Of course, I do cook my food.
Yeah, so you can talk about soups?
Maybe, but I can't be as good as a chef trained at a Michelin star kitchen.
I'm trying to see a topic you're able to talk because you've been here on several occasions for different conversations. I admire that particular level of...
Elon Musk has up to 9 businesses. So apparently he can talk across all of them.
I can call you Elon Musk of Africa.
I'm not able to know that title yet, please.
Now, we're discussing a very interesting topic today, which is the stock market, both international and local. So we'll start from local, then we'll now move to the international. Now, do you know why this conversation is so fascinating to me? There was one day I actually had a little chit chat with a vulcanizer. And as we're talking, I was just trying to do some research on him. I don't say, how is business going? He told me, yeah, fine. I said, okay. How many children do you have? He said he has 3 children. And you're actually sponsoring them through this business? He said, yes. I said, how do you do it? He said, although, so it became interesting. He said, although he's actually making profits and he's saving this money in the bank. But the only problem is that most times when he goes to the bank to save it, this money cannot just buy the things he has saved the money for. I mean that over time, the value of the money keep reducing. It's melting like ice cream. So
in the desert.
I feel that somebody like him needs a lot of exposure to how the stock market works because I think he can actually do something great through the stock market. So now I would like us to start from this place. Is it possible for somebody that have a saving, let's say you have something like, let's say 100,000 naira saved in your account, maybe 200,000, maybe 300,000, and this is your, not just your capital, this is your all in the bank as I saved. Is it advisable for somebody to actually use this particular sum of money to start participating in the stock market? And if yes, how can the person actually start? Let's start from there. Okay,
so thank you very much for having me once again. So 100,000 is even more than enough to start gaining exposure to the stock market. So you would want to, you can start with 5,000 actually to buy stock. The reality is you need to start. You need to start. You cannot afford to stay away from investing. So the guy you just referenced, if he keeps 100,000, think about at the current inflation rate, we are looking at 18%. So what that means is that by this time next year, that money is actually worth only 82,000 naira. You can do the math. Next year, the second year, it keeps on losing value. and it eventually turns to dust. But if he invests in the market, that's a way of, especially in instruments that can have at least beat inflation. Because when you talk about returns, absolute returns, you don't just talk about, I've made money. For example, let's say you invest in an instrument, a financial instrument that pays 15% per year, but the inflation is 18%. Your absolute return is actually not 15%; it's minus 3%.
Yeah.
So you are looking for instruments, financial market instruments,
actually give you
that can, products that can give you at least
that can match inflation,
that can match or most probably exceed inflation.
So what it means is that if you actually save 1 million naira in your account, an interest of 5%
yes
per year.
Yes.
And,
no bank actually pays that
no,
amount.
let's say for instance,
But,
so now you now have inflation at 18%.
Yes.
What you're doing is that money is gone.
You have lost 13% on that money per year. 13% of 1 million naira is 130,000.
So every
So you literally
losing 130,000,
picking 130,000 and throwing it away. So that's exactly what you're doing. So it is not advisable for you to do that. A lot of people are not educated to understand that you don't need so much to start. I know of someone that literally started with, I think she started with just 4,000 naira. Today, she has a very huge amount. The thing about it is, once you develop that discipline to invest with something small, it cascades. Some people will say, okay, if I have enough money, let me wait until I have so much money, then I'll start to invest. It doesn't work that way. You have to start investing the little you have. You invest the little you have, and then over time, you build that culture, you build that discipline that will allow you to invest even more. The reality is that you are most likely going to fall for what we call lifestyle inflation if you don't build the discipline of investment. For instance, let's say you say, okay, I'm going to be investing, you're a single guy, then I say I'm going to be investing 60% of my resources into the stock market. What that means is it's going to be you're going to have to be 60%. If you're earning 100,000, 60,000 goes into investments.
Okay.
That means if you're earning 500,000, if you're earning 300,000 has to go to the stock market. You don't say, oh, I still doing 60,000. No. So that is how it works. So that you don't inflate away your lifestyle because you've gotten more money.
Yeah.
That's so you build that discipline from the ground up. And then, like you said, how to get started. There are so many options that you can actually use to get started. Nowadays, we are going to talk about more of those later. But nowadays, there are several tools that allow you to gain exposure to the stock market. The thing is, you just need to be educated enough to understand that you need to be in. There's value in being in the stock market.
So the goal now is not the amount of money you have.
Yes, it's the discipline to start.
Okay. Now, one of the problems people have about savings is because they are afraid of the rainy day. Now they have this issue that what if I have an emergency problem?
Okay.
And I need cash, and I need liquid cash like instantly. Is it possible to actually have a stock, invest in a stock that has liquidity that you can sell very fast and actually make money to solve a pressing need?
Number one, yes, there are a lot of stocks, and that's actually what stocks are, especially liquid stocks like banks. Bank stocks are very liquid. You can literally sell it, with a click these days. So you can actually sell. But here is the deal. Like I said, I did not tell the guy to invest the entire 100,000 into the stock market. You have to build some kind of emergency fund. You invest in the stock market, a part of your resources in the stock market. And here is the reason. Remember that when you invest in the stock market doesn't just go up.
Okay.
There are bull and bear markets. So if you invest in the stock market and have nothing else left, let's say you put it 100%, there is a risk you are running, and that is that what if something happens? Yeah. What if life throws curveballs at you? What that means is that you are most likely going to sell at a fire sale price. So, for example, the stock gets a hit, and then you have to sell the stock, what that means is that you might sell at a loss. So you always want to have emergency fund to ensure that you prepare you are prepared for the rainy days. That's number one. Number two, there is a strategy that we call, which I tell a lot of my friends and some people that look on to me for advice or some kind of information around investing. There is something we call buy, borrow, die strategy. This is the strategy that billionaires use. They buy, they borrow, they die strategy. So billionaires scarcely sell their assets. They don't.
Okay.
Actually, what they do is the income they have, they actually use and buy appreciating assets. That is the buy part of the strategy. They buy appreciating assets with their income. Then the borrow strategy, the borrow part of the strategy means that if they need money to fund their lifestyle, they actually don't sell their assets, because when you sell your assets, you will trigger a tax event. Meaning, of course, there's something we call capital gains tax. If you invested 1 million naira into a stock, that stock does, let's say, about 50%, you now have 1.5 million. 500,000 becomes your capital gains. And then let's say the tax on capital gains is 10%, you are going to have to pay 50,000 naira to the government or to whoever is in charge of collecting the tax. Now you can think about billionaires that have billions. So that could result into such a huge amount of money. So what billionaires do, and what I encourage people to do, is to borrow against your assets. So for example, in the stock market, I think you can get a loan to value ratio of about 50% is tenable. Yes, it's tenable, really. So you can actually borrow against your asset. So number one, you don't have to sell your asset and trigger a taxable event. Another reason is that you don't have to sell your asset at a time when the asset has lost value. Maybe it's in a bear market. So you don't have to sell, because once you sell, you have locked in the loss. But as far as you have not sold, your loss is actually like what we call a paper loss. Yeah. But by the time, because it's possible for it to come back up, get back up above break even and into profit. So what you want to do is to always think about borrowing against your assets rather than having to sell your assets. Now, the last part of it for billionaires is what we call the die. The die part of it is that when they die, that asset resets to there's something called step-up basis. So what that means is that when you die, the base of the assets, or what we call the cost basis, resets to whenever you die. So let's say, for example, you bought an asset for 10 million naira.
Okay.
And then in your lifetime, you've been borrowing against it. In your lifetime, it's gotten up to 100 million naira. You should be liable to a tax on 90 million, because that is the capital gains. But if you die at the time when that asset is worth 100 million, your descendants or your heirs will not have to pay tax on that 90 million, because there is a step-up basis. Your heirs are inheriting that asset at 100 million naira cost basis. So they don't have, it's called step-up basis, so they don't have to pay any tax at all. If your heirs also use the same strategy as you, they borrow against the assets, when they die, the people that come after them will also get the cost basis as this price at the point that they die. So you realize that you can literally
keep the billionaire status.
You can literally keep yourself away from paying such huge taxes. But the reason why we're saying this here is we should look long term. We should not be such in a hurry to sell assets, because assets actually are things that make you to be rich. Liabilities are things that make you to be poor. So assets, you can borrow against your assets, so you don't have to sell and trigger a tax event.
Now, you see, since you've come to actually talking about selling too early, now, I'd like to know, what do you think are the major mistakes most investors, especially beginner investors, actually make? Is it about leveraging? Is it about choosing the right asset? Is it about selling too soon? What do you think they are the worst mistakes or the easy mistake a beginner investor can make?
I'm going to mention 3 mistakes, and I'm going to mention them in order of the most terrible mistake is chasing hype.
Okay.
So, for instance, you see a particular stock is making crazy profit. Wow. Someone said, oh, it made 50%. It was up 50% yesterday. Oh, before then it was up 30%. Over the past 1 month, it's been up 230%. You see, beginner investors will FOMO in. It's called fear of missing out. They'll FOMO into that asset and buy. Let me not go far. Just of recent, gold got to $4,400. Now, there was a video I saw of people queuing up in Australia, long queues of young people
to get to 10,000
to buy. Yes, young people queuing up to buy gold. As I speak with you, gold has dropped below $4,000 today. You can see the dangers of chasing hype. So investors don't even bother, or beginner investors don't even bother to look at fundamentals. The reason why gold went up was because of geopolitical risk. It was because of government. It was called the debasement trade, the debasement of the US dollar. Now the US dollar has somehow, the DXY has somehow stabilized. The US-China trade tension has actually subsided because yesterday Scott Bessent, the Treasury Secretary, said that they have reached a very workable framework. Guess what happens? Gold was riding the wave of geopolitical dislocation, debasement of the US dollar, and some of these narratives have changed rather quickly. So what that tells you is investors' sentiment will also change accordingly. Imagine a beginner investor that bought in at 4,400. You have literally lost more than 10%.
Yes.
You have literally, at this point, you have literally lost more than 10%. And guess what they would do? They will immediately sell because they see their capital lose value by 10%. And some of them came in with the mind that if I invest $10,000 now, in the next few days, it will get to $15,000. Now, instead of saying that, you are now seeing a depreciation of 10%. From that $10,000, you are now seeing about $9,000 in your account, in your brokerage account. They would immediately sell off. What are the chances that gold recovers? So the thing about it is investors chase hype and then they sell too early. That's number one. That's in the block. The second terrible mistake that most investors do is that they do not look at fundamentals of stock. That's what we see some of these things that we call meme stock that show up.
Yeah.
A company doesn't really do anything at all. It just has hype. People talking about it, meme stock. And so investors don't even think about doing research. What does this company do? And what is the long-term demand of these assets that they are producing? Now, there's something that Warren Buffett said. He said that the stock market is a voting machine in the short term and a weighing machine in the long term. What does that mean? It means that in the short term, hype can actually push the stock up. But in the long term, it is the fundamentals. That's why I say it's a weighing machine. It's the fundamentals that actually support the value of a stock. So now, we see a lot of things around AI. Everybody is scampering for AI names and all this. I'm not saying that we are in a bubble, though, but I'm saying that investors should be.
Do you believe that AI bubble will burst one day?
So I'm going to give you some numbers because I believe that, like they say, humans speak, numbers scream. I don't think that there is an AI bubble now, and I'm going to tell you why. Let us go back, because a lot of people that talk about bubble, they always make reference to 1999 when we had the dot-com bubble. Yeah. Okay, good. I want you to look at some things, and it is very similar because in 1999 the Fed was actually on a tightening cycle, and then started cutting interest rates in September, just like what we have now. And then if you look at some names, I'm going to give you a name, Cisco. At the time, Cisco was trading at over 50 times forward earnings at the time the Fed started cutting rates. 18 months later, Cisco was trading at over 200 times forward earnings. That's an insane valuation.
Yeah.
Today, Nvidia being the number one name when it comes to AI, guess what? It's trading at 27 times earnings. It's not even up to the value that Cisco was trading even before the Fed started cutting rates. So when you look at in terms of valuation, especially when it has to do with multiples, I think the multiples are still low. For context, do you know that Costco is trading Costco and Walmart are trading at a higher valuation? Walmart is trading at 32 times earnings, but Nvidia is trading at 27 times earnings. So what does that tell you? It tells you that if you look at a bubble, I don't think AI is where you should be looking at, because the names, the valuations of companies in the AI companies are way lower than even membership companies. So I don't think that is the case. That's number one. Number two, you see CEOs of AI companies every day, they come around saying they cannot meet up with demand. When you are generating revenue, you are generating profits, you can't be talking about a bubble. A bubble is where you have a lot of an insane valuation that does not match the output, the revenue generated. That's when you talk about a bubble. But look at the numbers that these companies are printing. Look at the numbers that Nvidia is doing. Look at the numbers that a lot of these AI companies are doing. They are doing insane numbers. So you cannot be talking about bubble. Is there a hype? Yes. But do we have a clear bubble? I don't think that the numbers.
Even if the bubble burst, it will not actually end AI. AI has come to stay.
Yeah, it does.
Because even the 1999 bubble that was the .com bubble, not end .com.
No,
we
so
still have tech companies.
Yeah, we still have, but we are talking about the context of investing. Because when bubbles like that burst, there is a domino effect. So, for example, let's just say that Nvidia, all of a sudden, people believe that Nvidia is not worth what it is trading at. It's currently worth about $4.6 trillion with a T. Let's say it's not worth that amount. So what happens? People begin to sell off the stock, and it's not just going to affect Nvidia, it's going to affect the entire tech industry. Because if you look at the S&P 500 currently, what is driving the S&P 500, the numbers you're seeing in the S&P 500 is actually AI names.
Yeah,
the AI names are the ones driving the current valuation of the S&P 500. So if something happens to that narrative, if people think it is actually a bubble, then it will lead to a cascade of sell-offs. Yes, look at what happened when DeepSeek showed up, and investors believe that future AI demand or GPU demands would actually take a hit. They did what they sold off. Nvidia lost recorded double-digit loss in a particular single trading day. So this is exactly what a bubble could look like. Not that some companies, of course, companies will survive the bubble and will come stronger, but you're looking at the broad market, people losing money, investors losing their investment and all of that. That's why we don't want to talk about having a bubble.
Let's stay on the fundamentals, because we've actually tilted towards that way. So let's stay on the fundamentals. You see, for those who are beginner investors, or those who are just coming into the market, or those who would like to come into the market, the stock market. Now, I want us to break down what the fundamentals are that they have to pay attention to before actually investing.
Yes. So the first thing is, before you think about investing, you have to do your research. There is no substitute for that. And nowadays we have a lot of tools. We have ChatGPT, we have a lot of AI tools. If you don't want to invest, if you don't want to do the research, why don't you start with the broad market index? Something like the S&P 500, the Dow Jones Industrial Average, NASDAQ,
ETFs.
Those are ETFs. Those are indices that actually. So the S&P 500 actually tracks the top 500 companies in the US. So why don't you just invest? The reality is that even Warren Buffett had a hard time beating the S&P 500. So you'll be comfortable with that. The S&P 500 over the past several decades has returned an average of 11 to 13% on your money. If you don't look at the fact that the US inflation in the US is hovering around 3%, the last figure that was published a couple of days ago actually says that the CPI headline inflation is 3%. So if you deduct 3% from 11% and maybe a few management fees and all that, you're still left with a positive return on investment. So you can start from there. Before the more sophisticated you are as an investor, you can now begin to look at some of the names around AI, cybersecurity, blockchain. There are a bunch of other specific industries you can.
There are also data companies that fund.
Data company. I mean, look at what I mean. These are very good. AI companies, Palantir. You saw how Palantir has been reaping. You can look at Oracle and all of this.
Even their cooling companies.
But the point is, I'm not a financial. This is not financial advice, not legal advice.
Take advice. Don't take advice from
somebody. This is not tax advice, please. But the point is, you want to do your research. You can start with a broad market like the S&P 500 and basically the indices. The indices means that you don't have to pick and choose which company wins. The way it works is the S&P 500 from time to time continues to rate. And then they add new
working companies.
Add new companies and remove the ones that are not performing. Good. So that means you benefit. You are literally like spreading your eggs across. Yes. So that's what
take you the pains of trying to do personal research.
Yes. So that's what investing in broad market in this.
You're a big investor in the United States economy. So let's bring it down to
okay, so if it's in Nigeria, we also have the same thing. We've seen a bunch of banks that have been performing. The banks have been doing very well. Telecoms have been, telecom companies. Industrial companies have been doing very well. The only challenge has been around the fact that, except that now with the stabilization of the naira, then it makes a lot of sense. Before now, when inflation was still hovering around 36%, it was a bit challenging because if a company does 20%, that should be an insane return. But because it's a loss, it's a 16% loss because of the inflation. So, and the instability of the exchange rate means that what you think you are earning, if you look at it in absolute terms, which is in dollar terms, then it's actually not something that you might want to think about long term. So there are different instruments that you can actually use if you decide to invest in the Nigerian stock market. But again, nowadays, the reason why I'm not really talking restricting Nigerians to the stock market is that the global market place is available to everybody nowadays. And very soon, with the tokenization of stocks, which is happening at speed in the US, as a matter of fact, the SEC chair, Paul Atkins, rolled out what they call Project Crypto, which is to move the US financial markets on chain. That means you will be able to, from any part of the world, there are no barriers. From anywhere in the world, you can actually invest in the US stock market. And of course, other markets are going to follow accordingly. So the thing is that we live in a global environment. So we should be expose ourselves to global opportunities and hedge against market volatility and hedge against currency devaluation and hedge against inflation.
All right, now one of the major questions people actually ask is what is the best time to actually invest? Some will say, is it when there's a policy change? Others will say when inflation comes down. By your own advice, now what is the best time to actually invest in the market?
One terrible thing you can do, which is trying to time the market. Like they would say, time in the market will always beat timing the market. That being said, there are some, I would say there are some conditions, there are some macroeconomic conditions, especially when you have a lot of macroeconomic headwinds that negatively affect stocks. So you might want to, unfortunately, investors act differently. When you should buy into the market is not when the green candles show. Actually, you should be buying into the market when there's blood in the street. I always say it. When there's blood in the street, including your own blood, that's when to buy. And that's how some high net worth investors, they buy at a time when there's blood on the street, because you have the potential of multiplying your gains. Having said that, you could be looking about something around when the macroeconomic headwinds are starting to reverse into tailwinds. So, for example, using Nigeria as an example, we had such insane headwinds from moments ago, which was around dollar, the exchange rate, inflation, because this exchange rate instability and inflation was kind of scaring away investors, especially foreign portfolio investors. So that meant that the liquidity in the market was very thin. So now that is changing. So you might want to gain exposure to the markets, because what drives the market is liquidity. Once you have liquidity, then the market is going to move very well. If you don't have liquidity, it's a very fragile environment to work in. So for me, I would say don't try to wait until the time is perfect, because actually nobody has ever been able to properly time the bottom. Nobody also has been able to properly time the top. So the fact is that you do what we call dollar cost averaging. Dollar cost averaging means you buy in at certain times. So if you buy in at specific times, so if you could say, okay, I will buy a particular stock every Monday, then you make ensure that you are very consistent about buying stocks at that time. What that allows you to do is you smoothen out your entry price. Yes, so let's say you bought a stock at $60, and then that stock tanks, let's say, to about $40, you buy. Then it goes back to 50, you buy. It goes to 30, you buy. You are
a specific amount.
Yes, and because you're buying, when you look at your average buy price, it smoothens out. Rather than commit everything at once and buy at $60. What happens when it gets down to $30? You feel very terrible, because you will have bought twice the volume if you had just maybe waited at that time. So the idea is for you to, because you cannot time the market, you cannot time the market itself, you cannot time the bottom really. You just have to default to the dollar cost averaging, and that will help you in the long time to smoothen out your entry price.
Now, one of the problems we have, especially in Nigeria, is the jackpot syndrome. What we call people migrating from Nigeria to other countries. Now, as an investor, don't you think this large-scale migration have a negative effect on our earning powers, or on the different companies, on the ability to earn, the ability to have workforce, able to work and also earn money? Won't that actually affect investors coming to invest in Nigeria economy? Okay,
so there is a nuanced approach to that. First of all, yes, I'm looking at from the angle of the skilled manpower that companies need to be able to produce and be competitive. We are in a global economy now, so you need to be competitive in order to have a chance of being successful. So when you have some of these very skilled talent leave the country, the chances of Nigerian companies building that competence and being competitive is very, very, it's quite impacted. The second thing is that it's about consumption. Companies need consumption, steady consumption, in order to be able to make profit. And you look at the segment of people that actually leave. You have doctors, you have engineers, you have the high-skilled, high-income earners. When these people leave, they're actually living with that consumption. So the consumption drops, and when consumption drops, companies are not able to have enough consumption to service, and then it takes a hit. Their bottom line takes a hit. So what that means is that jackpot syndrome actually has that negative effect. But on the other side, on the flip side, when these people leave the country, what we tend to observe is that they repatriate so much money. You have a lot of diaspora remittances that come into the country, and these funds are actually used to fund consumption in the country. So it's not an entirely negative thing, even though when you look at you arbitrage, you look at the net effect is actually negative. But to some extent, you have remittances, you have diaspora remittances that actually help to fund consumption in Nigeria.
Now, let's focus on other companies outside Nigeria. Now, the S&P 500, NASDAQ, and the rest of them. Now, they've actually had a year-to-date performance of 16%, 21%, 11% till now. Now, do you actually advise, is the best time to still allocate resources to them, or should we wait for a pullback?
Okay, so I think it's a good time to allocate. And I'm going to explain why. So remember that the Fed has been on a pause. One of the longest pause you can think of. And they just started cutting interest rates in September. That's last month. And so what that tells you is they are starting an easing cycle. Last week, the Fed chair, Jerome Powell, actually talked about ending quantitative tightening and actually ushering in quantitative easing. So what that means is that risk assets, the stock market, actually benefit immensely from this. So you are going to see most likely going to see an explosive growth in terms of things like stocks, things like even crypto is going to experience, because these are the Fed ending QT and starting QE. In fact, as a matter of fact, there are actually they have over the past, I think, several months, they have actually been unloading their balance sheet. They have stopped. Okay. So it's a complete reversal to quantitative easing. What that means is that this is a very good macroeconomic tailwind for stocks. So I think it's a good time to buy. Most of the time, historically, when the Fed resumes interest rate cuts after such a long time, the S&P 500 does a minimum of 13%. So you might see another 13% on the S&P 500 as we move into year-end, and of course by next year 2026. So what I would say is that you might want to think of allocating to these indices. We've seen some very shallow pullbacks. In fact, a couple of on the 10th of I think there was a dislocation that happened on the 10th of this month, when Donald Trump announced a 100% tariff on China. Yes, so the market lost. The S&P 500 only corrected by just 3% on such a huge. So I'm thinking it's more of investors looking for an opportunity to take profits. Those kind of deep pullbacks that we're expecting, like the 10% pullbacks, that like the kind of pullbacks we had during the Liberation Day tariff, we don't seem to have them. In fact, investors are looking at any dip as a buying opportunity. So you waiting for a pullback, a reasonable pullback before you allocate, I think it's going to be a wild goose chase. So like I had said earlier, don't try to time the markets. Your focus should be in being in the market so long that you can actually make gains. Let me speak just briefly about even the crypto market, for example. I hear a lot of people saying, Bitcoin has not done very well, even with all of these tailwinds. The reality, and people think that Bitcoin is going to stay where it is till year end. The reality is that the gains in Bitcoin actually happens over 10 days. In 10 days, Bitcoin posts its biggest gains within 10 days. So if you miss out on those 10 days, you miss out a lot on the gains of Bitcoin and other risk assets, crypto assets. So the fact is, the bottom line here is you want to focus on dollar cost averaging. You want to focus on not trying to time the market. You want to focus on the macroeconomic tailwinds that have come. Look at what is happening. The Fed is on an easing cycle. The macroeconomic shocks, like the tariff, US China tariff face off, has almost laid to rest. You are looking at the Fed is not just cutting, but they are ending the unloading of their they are ending the offloading, of their balance sheet. So these are some of the very, very positive things that will push the market higher. So I think it's a good time for one to allocate to the stock market.
To the crypto market. Now, I'd like to actually know, are there some macroeconomic tailwinds that actually convince you that you can now say boldly that we are set for a year-end rally?
Yes.
Okay, I'd like to know
there are. So number one, I had already said that the Fed has started interest rates, cutting interest rates. The second most important thing, if you look at what has happened in this year, the S&P 500 lost so much. The major indices lost so much during the Trump Liberation Day tariff, because there is a lot of geopolitical risk. There was a lot of geopolitical risk in the economy, which affects risk assets, and we are talking about risk assets here. Now you are having a complete, almost complete reversal in that regard. So that is a very huge tailwind. Now again, we also have the AI revolution, which is increasing productivity. So companies are no longer needing the huge manpower. And of course, you know that the bulk of company expenditure is in staff. So if companies are going to work more efficiently, companies are going to be more efficient courtesy of AI, that means balance sheets would improve. And if balance sheets improve, what that means is that companies will begin to have higher valuations. So if that happens, it means that it's net positive for the stock market. The other thing there is that if you look at this administration, I'm talking about President Donald Trump's administration, you can see that there's something they are called deregulation. Deregulation means all the bottlenecks that prevent companies from actually accessing the resources that they need to grow will actually be tackled one after another. You see there's a lot of investment in energy, which is going to support a lot of the businesses, especially in AI, in data, and all those. And these are some of the companies that are making some of the biggest gains this year. You are looking at the
cooling companies.
Is it? Cooling companies are coming in. I mean, look at the billions, the tens of billions and even trillions that OpenAI, Nvidia, these guys are actually committing into capex this year. So that tells, and this has a way of trickling to the rest of the economy. So that means the economy is most likely going to have a net positive outcome at the end of the day. So if this happens, these are very, very big tailwinds. These are things that you look at and you say, yeah, this would support a year-end rally.
Okay.
So once we are done with the geopolitical risk, once we are done with the risk, the monetary policy risk, which is with the Fed, then that means we are set up for a year-end rally like never before.
I'd like you to, let's stay on crypto, for instance now. Do you really believe that crypto ETF offer a better exposure to the market than somebody owning an underlying asset?
Okay. So
do they offer a better exposure to the market?
So there's a different approach to it. So for institutional investors, they offer so an ETF is like a wrapper.
Yeah, that contains
a wrapper. Yes, that institutional investors are used to ETFs. So what you are doing is basically to create an ETF, or like they say, exchange traded product that actually track the price of the underlying asset. So gaining exposure to the underlying asset itself means that you are able to go beyond. Number one, you are not getting any fees. You are not paying any fees. Number two, you go beyond just mirroring the price of the asset. Let me give you an example. If you have an Ethereum ETF, for instance, because Ethereum works by principle proof of stake. If you have an Ethereum ETF, you are basically earning from the price appreciation of Ethereum. Okay. But if you have the Ethereum yourself, and which is why to some extent treasury, digital asset treasury companies are actually trying to give people the upside that treasuries, that ETFs might not be able to give, which is that you can actually stake the Ethereum and earn 2.5% on your Ethereum. Yeah. You can also use that Ethereum in DeFi, meaning lending, providing liquidity and all of that, which will allow you to earn extra. You can actually use it even on EigenLayer for what we call restaking. So it actually allows you to amplify your gains. Unfortunately, ETFs, even if staking is approved for ETFs today, they might not be able to stake 100% of the assets because of what we call liquidity requirements. They are supposed to keep at least 50% of the asset to meet liquidity requirements in case someone wants to decide to pull out of. And by the way, Ethereum now has I think up to 42 to 50 days of queue. That's if you want to unstake your Ethereum today, you have to wait for the next 40 to 50 days. Before that is successful. ETFs cannot afford that delay. So what that means is that in order to meet liquidity requirements, they have to have only 50% staked, of the assets staked. So that the always 50% could actually be liquid, such that if an investor decides to pull out, they can honor such requests. So I would say that having the asset yourself. In crypto, they would say not your keys, not your crypto. But the other side of it is that ETF ensures that you don't have to bother about keys and all private keys and all of those things. So you know what I mean, if your keys disappear, then
It's gone.
Which someone would say, okay, I can do centralized exchange. The same thing, if the exchange collapses, is gone. So that's why institutional investors and some retail investors are looking onto ETFs, because they don't have to manage keys and all of that. But the trade-off is that you don't have the asset itself, the native asset itself, which you could use to do so many things like staking, restaking, and of course participation in DeFi.
Now, there's a lot of buzz about the tokenization of real-world assets. Even in the US, they're talking about tokenization. Now, how do you think this will affect the markets, especially to investors?
Okay, let me ask you a question. The US stock market currently, so basically trades for 10 hours.
10 hours, yeah.
Good. Now, that is if you include the after hours. Now, I ask a question. They make money.
Yeah.
What do you think the impact would be if they
Extend it.
trade for 24 hours? 7 days a week.
Make more money.
They will make more money. Okay, so what that tells you is that, and which is why the ACC chair, Paul Atkins, has actually literally encouraged the US financial markets to go on chain, because that allows you to capture more markets. Currently, do you know that there are several countries that cannot, residents of several countries that cannot actually buy into the US stock market? The same thing with even Nigerian market. So tokenization of stocks allows for everybody anywhere to be able to access 24/7 the market. So it actually would insanely increase liquidity, profitability. And then another thing is that tokenization allows you to have very fractionalized shares of stocks. That's one. Let's talk about real world assets. If you want to sell this building, for example, let's say this building is 100 million naira. You'll have to wait for someone that has 100 million to show up and buy this building.
Yeah.
Now, think about it. What are the chances of you finding such a person that not just has the money, but is interested in buying this building? It is very hard. But if you break down this building into, let's say 100 million naira, this building is 100 million naira, and you break it down to 10,000 tokens. 10,000 tokens would give you, if you look at that, will give you about 10,000 naira per token. It will give you 10,000 naira per token. You will agree with me that even someone that is working in the civil service can literally buy a part ownership of the building and participate in the upside of this building. Because most people that buy real estate, especially commercial real estate, are not buying because they want to live in there. They are buying because they want to gain exposure to the possible upside of that particular property.
Yeah.
So, but the way it currently is, you are shutting out a lot of people, and by extension, a lot of liquidity from the market by the structure you have, because you need the person that has the right capital and the right interest, to be able to close a deal. But if you tokenize it, you can have several people, that have lower means, that might want to be part of the ownership of this structure, to buy into the structure. So it actually decentralizes access to property. It also allows for verification. Remember, this is actually on the blockchain. I mean, if you go around and ask people and say, what is the biggest challenge you have when you're trying to buy a property, like a land, like a house? The first thing they tell you is what? Scam. They are most likely going to fall for scam.
Yes.
Good. But if it is on the blockchain, there is nothing like that, because remember, the blockchain is an immutable ledger. So you can see from when that token was minted, literally all the people that have held that token. And you can look at the contract address to be sure that you are buying the right token. So it's not something that you are going to fall for scam. So the reality is that tokenization will bring in transparency into the real world asset markets, will bring in decentralization, and will also literally democratize access to these assets, and will allow people to have, it will bring in a lot of innovation. Because if you think about it, people, in the real estate industry, because buildings are not liquid. They are called illiquid asset. What I mean by liquid asset is that if you want to sell your house now, you cannot sell it with a click of a button.
Yeah.
No, you cannot. So it's rather illiquid. If you make properties, if properties are tokenized, that turns them from illiquid asset to liquid asset. That means it improves liquidity and also allows for people to use their tokens or to use their properties or real estate for more purposes. Because nowadays, if you want to take a loan on a property, the challenge will be that the institution will be asking, how quickly can we liquidate this property to cover your, if you have a loan, if you want to take a loan to cover your loans and of course the interest, that will be factored into the pricing of that loan. But if the market is liquid, courtesy of tokenization, that means you'll be looking at a real estate property much the same way as you look at a stock, which is very liquid at the moment. So tokenization would, number one, improve the efficiency of the markets. Listen, if you want to buy a stock now, it takes about 2-3 days for the transaction to close. Clearing houses, a lot of middlemen, and that's why you pay a lot of fees. I don't want to mention them, but I know some. We are going to talk about later from some of the platforms that we have that allow you to even buy stock in the way that we're seeing it today. They charge, I think one of them, they charge for just to deposit. You pay about 2.5%.
Yeah.
Then to trade, you pay about 1.5%. Then when you are buying, when you are selling, you pay. So when you look at all of these fees, how much are you even making? Let's say you buy into the S&P 500 and you are making just maybe 11%. And then you pay about 6.4% on fees. That takes it down to 3%. Less than 5%. Less than 5%, that's about 4.6%. 4.6%, and then your inflation is what? It's about 3%. That means your real return is actually 1.6%. So when you look at that, it actually nibbles away at what you would have gained. But if that stock is tokenized, remember, look at the platforms like even Solana. The fees are almost invisible. They are extremely low in cents actually. Your fees reduced to less than a penny actually. So every gain that accrued to that particular stock comes to you. Okay. So that's why tokenization is going to bring a lot of efficiency to the market. It's going to bring a lot of liquidity to the market. It's going to bring a lot of democratization, to the market. More and more people. The statistics show that I think about close to 70% of Americans don't even have access to the stock market. In Nigeria, it's even worse. If you go around and ask people, they don't even know what you mean by the stock market. So, but because, if you look at the fees to pay and the minimum requirements, remember with tokenization, because it's very fractional, you can literally invest only 1,000 naira, even 500, you can actually invest in the stock market when it is tokenized. Okay. So that would allow access to the market to a whole new segment of people that would otherwise have not had access to the market.
Okay. You see, now, recently, maybe some few months ago, maybe 2 months, maybe July, now President Trump actually signed the Genius Act into law, now which provides a regulatory and legal framework for stable coins. Now, as an investor, how do you think that impacts the investment landscape, like the investment market?
Okay. So the Genius is short form for Guiding and Establishing National Innovation for U.S. Stable Coins. That act provides clarity. It provides legal and regulatory framework for stable coins. And what that means is that it opens up the market. Okay. If you want to invest in US dollar denominated assets as a Nigerian now, what options do you have? You have to go to Aboki
and change.
Buy the US dollar. And by the way, the Aboki don't sell. Let's say you want to buy. Let's use an example. Let's say you want to buy just $10. Aboki don't sell it.
Yeah.
Okay, so that means you are shut out of the market. But with stable coins, with this framework that actually recognizes stable coins, it gives it a legal tender status. What that means is that rather than having to run after an Aboki person with an amount that they won't even accept, you can use as as low as $5. You can literally buy US stable coins or like something like USDT, for instance, and that would allow you to invest in the US stock market and other dollar denominated markets. So that means it opens up, like I told you, investment thrives on liquidity.
Yeah.
Currently, the population that we're shutting out because of the structure we're running is insane. If you look at the numbers, a majority of Nigerians are not investing in the stock market.
They don't even know what is investment.
They
see that as a very technical task.
So and that's why, because of that, a lot of Nigerians fall for scams. Because when you talk about investment, they think about, I mean, we saw the one that happened recently. They think about a quick get rich quick thing.
I feel like it's Forex.
Okay, like Forex. The moment you mentioned Forex, I mean, so you are looking at having an infrastructure or a policy program in place, or a regulatory framework, a legal framework that allows people to have easy access to the resources, in this case US dollar, to be able to invest. Because in as much as I'm a big fan of the Nigerian stock market, I also know that the number of Nigerians are trying to hedge against currency risk, hedge against debasement of their currencies, and hedge against inflation, government policies, and the rest. So they would also they have a lot of appetite for the foreign markets, for the US dollar denominated assets. So, but how are they able to access it? The Genius Act allows them to be able to access, because as a matter of fact, if you want to buy a stable coin now, you can do that in less than 2 minutes.
Okay.
In less than 2 minutes. So that means that allows you access to the resources that you need to be able to invest in some of these markets and gain exposure to the possible upsides in this market. So the Genius Act is a very, very welcome development for investors, especially those that are interested in USD denominated investments.
All right, let me ask the last question before we go. You know, we've said a lot about the markets, and most people are desirous of coming into the market. So I'd like you to expose those options that are available for those who want to start, and how would they start?
Okay. So currently, what I'm going to say now will change by the time we start tokenization of stocks. It will change completely.
When will it start?
Well, it's supposed to start. I mean, the U.S. government is on shutdown, so essentially that is actually in the coolers for now. But as from next year, NASDAQ has already filed for clarity or an approval to tokenize their stocks.
Wow.
So we are looking at, by 2026, we are going to have an influx of stocks that have been tokenized. So which means it would allow access. Nigerians can have access to the stock market without needing to have a traditional brokerage account. Okay. So what that means is that you will have access to, NVIDIA,
S&P 500.
Tesla, the S&P 500, all of these. You'll have access to them in the same wallet that you have your Solana token, that you have your Bitcoin, and all of that. How easy can that be? Because again, remember, this trades 24/7, meaning that you can exit and you can enter and exit at any time. Yes, so that is going to be the case, maybe as from next year. But for now, you can gain access there are some tools that allow you to do that. For example, I personally am using Bamboo.
Okay. I use Trove.
You use Trove, okay.
There's Chaka.
There's Chaka. There's a bunch of, but just know that it's not tax or financial advice, please. But yeah, so we use this. I'm using Bamboo to be able to access most of the US stocks.
You're not doing branding for them.
No, I'm not doing branding. Of course, I'm not doing branding for them. But again, you want to recommend something that you have used and you've not had issues, because again, a lot of people will listen to this and begin to yellow into getting some of this asset.
Financial advice,
but it's not, please.
Do your research before you actually use anything.
Do your own research, please. So you can actually do that, and that it allows you to start with as low as even 10,000 naira.
Yes, even 5,000.
So even 5,000. So you can start, and like I said, at the beginning of the program, it's about your ability to be consistent with your investment and understand the fundamentals. So when you go there, you will see, and the way they structure it, that you can, if you are confused, there are some people you can actually follow. For example, you can decide to follow Warren Buffett, you can decide to follow a bunch of people, Bill Miller, and a lot of successful investment fund managers and hedge fund managers. So that arrangement is there. So that means you can start from there. Like I've always said, you start from indices, because this takes away the hassle of having to pick winners and losers. Then from then, as you learn, as you study companies more, you can begin to see how to allocate to names, especially niches that are most likely going to gain some good upside. So you want to gain exposure to the stock market through these through these apps, and these apps are available. Please be sure to download from the App Store, so you don't
also
have
do your research.
Also, you do your research, please, because you never could tell what these guys are doing nowadays. So you want to do your research, invest in these stocks, and then investment is not a get rich quick thing. Don't be in a hurry, or you invest and then you keep on checking your app every single minute. People that check their app every single minute scarcely make money, because you are going to work emotionally. You are going to be emotional about your investment. You see a 2% dip, and maybe while you're having a 2% dip, maybe in Tesla, for example, then you see that Nvidia is shooting, about 5-6%. Say, woo! I should have done Nvidia. Then you sell your Tesla
and go to Nvidia.
And then Nvidia starts coming down. And then Palantir is moving. Woo!
You sell it.
And at the end of the day, you only stop when you have lost all your money. So you don't want to have that as your situation. Rather, you want to invest as a long-term plan. Like I said, you can, if you need resources, you can borrow against your investment. So you don't have to sell at a time that is not convenient, that is not good enough, especially if the stock gets a hit. From time to time, we have what we call market dislocation, meaning the value of a stock does not match its fundamentals. Because, like I said earlier, like Warren Buffett said, the stock market is a voting machine in the short term, but a weighing machine in the long term. So maybe at that time, the hype is out of the stock that you are looking at, but the fundamentals are there. What that means that in the long term, you will recover, your investment will recover and actually start making money. So what you want to do is to invest and then allow it to sit. Invest and not just allow it to sit, but also look at diversification. A lot of us will go and dump in everything we have into one stock. No, you don't do that. No matter how much you are convinced that stock will go up, there are just so many things that can happen, and an industry, a particular company, could go down. I remember in last year, I was very heavily invested in CrowdStrike. When that incident happened, that global outage, CrowdStrike crashed all the way down to $220, $223 per share. And if I were emotional about it, I would have sold. But as I speak to you, CrowdStrike has doubled that amount.
I something about the market. The market is a circle.
Yes.
From what I've observed, it will always come back.
Yes.
It will always come back. No matter where it will always come back.
Yes. Let me give you an example. Tesla, I bought into Tesla at, I think, $229. By the way, that was at the time that Tesla was literally tanking, when Elon Musk was involved with the White House. Tesla was tanking. You just open your app every single day and you see Tesla is making a new low. Every single time. I'm telling you. So I bought it because, for me, the reason why did I buy at that point is because I looked at Tesla's valuation, the price to earnings ratio. It's currently trading at 255. Think about it. 200, for context, Nvidia is trading at 26 times earnings. Tesla is trading at 255. So I wasn't comfortable. At the time, I was trading at 175 or So I was not comfortable. I just waited. My waiting was not because I was trying to time the market, but I was waiting for a lower valuation. Though I know that Tesla is not a car company actually. If you look at Tesla as a car company, you failed. Tesla for me is a tech company. They are very much into robotics. Look at Optimus robot. Look at full self-driving. There are a lot of things that make Tesla to be valued as a tech stock. Now, but even at that, I was looking at 175 times earnings as something that was on the high side. So I picked it up at 132 times earnings. And as I speak with you, it's gone back up to 255 times earnings. So you realize, that's what I'm saying. You don't just buy an asset and then once a slight correction happens, you sell. No, that's panic selling. Rather, you buy a stock that you know has strong fundamentals.
And you wait.
As far as it earlier this year, Tesla was not doing anything at all. As a matter of fact, as that other companies were moving. In fact, it was the worst performing of the Mark 7. It was terrible. So I just sat with it because I knew that the fundamentals are good. I knew that the Optimus robot, that project will be explosive when it comes out. Yeah. So I stuck to the brand. I stuck to that particular stock because of strong fundamentals. And the rest is history. Now it's gotten back. It's literally doubled my investment, as a matter of fact. So
you're doing well.
No. So you have to remain committed to a particular, as far as you have defined your investment thesis, you have to remain committed. Don't do this one here, this one. You also have to understand which kind of investor you are. Some people cannot stomach volatility. Yeah. If you cannot stomach volatility, don't go to crypto. I mean, on the 10th of this month,
People lost their lives.
People lost their lives because crypto lost 19 billion. Traders, 1.4 million traders were liquidated to the tune of $19 billion in just 24 hours. So what does that tell you? It tells, and some assets actually did 70%, lost 70%. Some assets actually lost 80% of their value in a single day. So if you are not able to stomach that kind of volatility, then stay away from the crypto market. You want to do it in indices. Indices, very terrible day. You are looking at, as a matter of fact, there's something that we call circuit breaker. So which means that if the index, S&P 500 or any of the broad markets index falls to a particular level, then the stock market gets closed. Will be closed to avoid further fall. Unfortunately, incidentally, there's no circuit breaker to the upside. So a melt up,
you can go as far.
You can go as fast. So what that tells you is that you need to really understand the kind of investor you are. If you can stomach volatility, then you can look at allocating to crypto. But if you cannot, then stay with the broad market index.
All right. Now, many thanks. I don't think I can actually appreciate you more than you've actually done justice to today's conversation. You see, I've also had a better understanding of the market. I've understood so much about the market. Thank you for coming. I think we should continue this conversation again next time. Maybe we'll bring you not for another thing, just for still the same thing. Okay. Thank you for coming. And that's how we actually will draw the curtain for today's episode of Clockwise. My name is Providence. And please don't forget that the elite of the 21st century are not those who did not go to school or those who will not go to school, but are those who have refused to evolve as their environment is evolving. Please also do not fail to like, subscribe, and put on the bell on this channel, because I will see you again.